Okay. So chapter 9, practice. So we didn't get through all of chapter 9 because some of it gets a little long, but we have a couple examples on disposal of assets at the end of their useful life. So we'll kind of talk about disposal when we get to those questions. This first one's just doing depreciation, first couple. So this one's units of activity depreciation. So it says we acquired a truck at the cost of $69,000, and it had a residual value of $12,000. Its estimated useful life is 300,000 miles, and it was driven 77,000 miles during the year. Determine the following. If required, round your answer to 2 decimal places. Well, how do I calculate depreciable cost?
Cost minus residual value over the total.
You have just the first part. Yeah, on your depreciable cost, you're given the whole depreciation formula, which is good. But yeah, just your depreciable cost is your cost minus residual value. Okay. Okay. So again, depreciable cost equals cost minus residual value. The depreciable cost is just the total amount we're going to depreciate this asset over time. So I would just take what, 69,000 minus 12,000. Why am I doing that? Can't subtract. So my depreciable cost should be 57,000. Okay, so depreciable cost minus the residual value. So we need to depreciate this truck 57,000 over its entire useful life. That's how much it's going to depreciate. Next, we're getting into the actual depreciation rate. Okay, so that was the formula you were giving me, right? So you were taking, then you're going to take depreciable cost divided by useful life. Useful life. And this is going to be in miles in this case. Okay.
Wait, wouldn't that be the straight line depreciation?
No, it's units of activity because we're dividing it by the useful life in miles to get our depreciation rate. So just for part B, to get how much we're going to depreciate it per mile, it's the same formula as straight line, but straight line uses like years. They use time. So with your units of activity, you're using total activity.
So we use 300,000 or 77,000?
You want to use the estimated useful life of 300,000. So yeah, we've already calculated depreciable cost. So it'd be 57,000 divided by the total useful life in miles in this case, or in units of activity, of 300,000 miles. So all total, what that's saying is we expect this truck to last for 300,000 miles. So its total depreciable cost is 57,000 divided by the total miles we think we'll get out of it of 300,000. So what's the depreciation rate per mile? I think I heard it. 0.19, very good. 0.19 or 19 cents a mile. Okay. So we just divided there. So with units of activity, you first have to calculate depreciation per, unit of activity. In this case, it's miles. So depreciation per mile. So how would I calculate the depreciation for this year? You'd multiply it, right? Well, how many miles did we drive it during the year? 77,000. Okay. So it says it was driven 77,000 miles during the year. So for this year, we used it 77,000 miles times the depreciation rate of 0.19. Okay, so we would just take 77,000 times 0.19, which is 14,630. So the depreciation for the whole year is $14,630. So it starts off, it's pretty similar to the straight line method, only you're dividing it by useful life total activity, okay? And that gets you a depreciation rate like per mile or per activity, unit of activity. So this may not be miles, it could be like, you know, machine hours or something else, okay? It's just whatever your total activity is. And then each year, we would just look at how much it was actually used and multiply it by that depreciation rate. So the second year, if we drove it 60,000 miles, we wouldn't have to recalculate the rate. We would just take 60,000 times 0.19, okay? So that depreciation, A and B are only calculated once, and then for every year, you would just calculate how much depreciation based on usage. Any questions on that one? Okay. The second one, we're still dealing with depreciation because that's a big concept in this chapter. So here we have a tractor acquired on January 8th at a cost of $85,000. It has an estimated useful life of 10 years, and it will have no residual value, okay? So it wants us to, in part A, determine the depreciation for the first 2 years using straight line method, and then in B, we're going to do double declining. So we'll cover all three methods. Well, they made it at least a little easy because we acquired it on January 8th, so that was the first month of the year. So we don't have to do a partial year's depreciation. Remember how we covered that sort of quickly? So we can just do full years of depreciation for both years. So what's your straight line depreciation formula?
Cost minus residual value.
Very good. Yeah. Cost minus residual value, which remember is your depreciable cost, divided by useful life in years. Okay, so that's straight line. I'm going to put SL for short, straight line method. Well, we have a cost of $85,000 and no residual value. That makes it easy, right? So our depreciable cost is the full $85,000 divided by 10 years. So it should be 85,000 minus 0, technically, divided by 10. So under the straight line method, we are going to depreciate this asset $8,500 each year for 10 years. Okay. So the answer is just $8,500 for both years. Both years are full years of ownership, so we don't have to worry about partial. Under straight line, you're going to depreciate the same amount every year. So once you calculate it, you know every year. Okay. It's the easy one, right? Double declining balance method is just a little trickier. If you remember, that's an accelerated form of depreciation. So what we have to calculate first under double declining balance, or DDB for short, okay, the first thing we're going to calculate is we have to calculate the straight line rate of depreciation, okay? So if you remember, step one, straight line rate. Well, it sounds a lot harder than it actually is. All you do to calculate the straight line rate of depreciation is take 100% divided by useful life. 100% divided by useful life in years So in this case, 100% divided by 10. I love it when they're easy, right? 10%. So the straight line rate is your first calculation. So you always take 100% divided by useful life in years. So 100% divided by 10, our straight line rate of depreciation is 10%. Okay. Step 2, you want to calculate the double declining balance rate. It's also really easy. Double declining balance rate is just double your straight line rate. So your straight line rate times 2, or 10% times 2. You're just doubling your straight line rate. Okay, so your double declining balance rate is going to be the straight line rate we just calculated and doubled, or multiplied by 2. Okay, so 10% times 2, 20%. So as long as you know to calculate it and do it in that order, it's not difficult, it's just extra steps. Okay. Any questions so far? So then step 3 is actually calculating depreciation for the years. Okay. It's where double declining balance gets a little trickier. Your formula to calculate the actual depreciation is going to be your book value times that double declining balance rate. Okay. Book value times the double declining balance rate. Well, then you have to know what book value is, right? Does anyone remember what book value is? How to calculate it?
Isn't it also considered the residual value?
No, yeah, your book value is different.
Cost minus accumulated depreciation.
Very good. Book value is cost minus accumulated depreciation. Okay, I'll write that over here. So BV for book value is cost minus accumulated depreciation. Your book value is going to change every year. Every year that you depreciate the asset, that book value is going to go down. Okay, so book value is what the value we listed on our balance sheet. So book value is always cost minus accumulated depreciation. Okay. Well, in year 1, have you depreciated it at all? No. So we haven't depreciated it yet, we're about to. So when we go to do our depreciation entry, our book value is just the cost in your first year. Okay, so in year 1, book value is the full $85,000 times the 20% rate gives us our depreciation amount. So how much is depreciation in year 1?
17,000.
Very good, 17,000. Okay. So in year 1, your cost is always your book value in year 1. Now this one, we didn't have a residual value, but just so you know, when you're dealing with double declining balance, you don't really worry about the residual value when you're doing these calculations. As you can see, like if it did have a residual value, my cost would still be the $85,000. Okay. So then we have year 2. Well, what's my book value in year 2?
$68,000.
Good. And how'd you get that?
Subtract the 17 from 85.
Very good. So we have to calculate book value for year 2. So we take our cost of $85,000 and we subtract out that $17,000 of accumulated depreciation. Okay, $85,000 minus $17,000. Our new book value at the beginning of year 2 is $68,000, and then you just take 20% of that. Which, what do you get for that?
13,600.
Very good, 13,600. $13,600. Okay. So under double declining, you're going to see a big drop from year to year. Okay. Year 3, it doesn't have it on here, but then we would take 68,000 minus that 13,600 to get a new book value, and then take 20% of that. Okay, so you're just going to keep recalculating book value and keep taking 20% for all 10 years. Do it.
Also, go for depreciation is a lot.
Yeah, it is. It's the more complicated one. And you do, as you can see, it is actually, in this case, since there's no residual value, you can see it actually is double the straight line, right? When there's no residual value, your depreciation amount is double the straight line. That's because there's no residual value. Any questions on depreciation methods? Not yet. You guys are real quiet. You guys have any questions on that? I feel like Tuesday we're going to be doing more examples. Either that or you guys all are getting this, right? It's either y'all really get it or you really have no idea what we're doing. And I don't know where you're at.
I'm just glad the test isn't on a Tuesday.
Well, it may get moved to a Tuesday.
Oh, God, please.
We'll see how we're feeling on Tuesday. Y'all aren't giving me a lot of confident vibes, though.
I'll go to the testing center and pick it up.
You know I'd do that for you. The test is ready, I think. That's really confident too, right? I think. I think it's good to go.
We just take it through Syncade, right?
Uh-huh. Yeah. We take it in class, but yeah. You'll just log into Cengage and take it. And I do let you have notes, so you guys can write this stuff down, you know. Do what? A peek, yeah, I usually, on financial, I usually give you like 2 pages front and back of notes.
Yes.
Like full pages. It's a lot. I mean, chapter 8 and 9 is a lot of material. Yeah, like, write really small. No.
I'm trying to fit all the notes on there.
I used to in college when my eyesight was better. I would type it all up in like 7-point font in different colors and then print it off and paste it on my note card in statistics. I can't read that font anymore, but I'd be like, can I use my phone for a magnifying glass? Oh, okay.
I mean,
Okay, so you guys got all of this down? Well, you got it written down? I'm going to erase it. Okay.
I got it all written down.
Okay. Okay. Okay, guys, let's look at the next one. Try to get through most of this. So this third one is on capital expenditures versus revenue expenditures. Honestly, it's not a huge concept, but it's good to understand because we're still dealing with assets. So we kind of briefly talked about this in the lecture, that the difference between capital expenditures and revenue expenditures. So what we're talking about here is money we're spending on assets, okay? So it could be that we have a truck and we're doing an oil change, or it could be that something broke on the truck and we need to replace it, or we could be overhauling something and improving it. So what we need to think about when we're dealing with these costs associated with these assets that are depreciating assets is it changing the useful life of the asset? Is it increasing the monetary value?
That's capital.
Yeah, so capital expenditures are expenditures on assets that increase the life or the value of the asset, or sometimes both. Okay, so a capital expenditure increases the value or the life. Yes?
So I got a semi, right? And break down, I gotta fix it, right? Is that helping the cost?
It's going to, yeah, when you have to make a repair that's not like an ordinary repair, so it's beyond like standard maintenance. You know, standard maintenance we would expense out. It would be a revenue expenditure. So like if you're doing an oil change or replacing tires or spark plugs, those are all just expensed out.
Like a whole new engine.
A whole new engine is going to add to the value and the life of that. So yeah, if something breaks that's not an ordinary wear and tear, it'll be a capital expenditure. Well, then that's a capital expenditure. Yeah.
Okay, go ahead,
Yeah. Yeah, that's a big capital expenditure. Into your brain, yeah. Right, yes, yeah. If you have to replace an engine or overhaul an engine, that is definitely a capital expenditure because that's not a normal wear and tear for an engine to go out. So that's what you need to look at. Is it just a normal wear and tear? Do I just need to, again, do like an oil filter change, do like standard maintenance, what's required at all the different mileages that, some of it we ignore. Like replacing air filters, changing oil, changing tires, even getting new brake pads, that's all pretty standard maintenance, right? It's required. So those are just what we call revenue expenditures, and we just expense them out. Okay? So that's an expense. A maintenance expense.
Is it? Oh, this might confuse some people. I'm comparing it to a restaurant. We have an account that's like operating supplies, and then another account that's other direct operating supplies. And operating supplies is like what we need for the restaurant to run, and the other one is just like, I don't know, pencils, office supplies, stuff like that. So it's kind of the same. Is that the same as like capital and revenue, or is that?
Not really, because you're like in a service organization. So your capital or revenue expenses would be like, say your oven broke in your kitchen and you had to replace it. Yeah. Yeah. So just on your tangible fixed assets. Yeah, good question. Okay, so let's come back to this one. So we have Quality Move Company made the following expenditures on one of its delivery trucks. So the only tricky part is, well, first of all, we have to determine is it capital or revenue. Yes, on March 20th, we replaced the transmission at a cost of $1,890. That is a capital expenditure. The kind of confusing part of this is then determining if it's increasing the value. Well, if we replace the transmission's kind of necessary, right? And you had to replace it because it broke. Are you really changing the value of that truck, or are you just keeping it at its regular value?
Change the value.
You're actually just keeping it at the regular value in that case. So if you're replacing a part that went bad, it's really just maintaining the current value because you need a transmission.
If your engine went bad, you're replacing that
But you probably, if you upgraded the engine, then it would be increasing the value. But if you replace the engine with the exact same engine that was in it, it's the same value. Do it. So that's where it gets a little tricky with capital expenditures. So it is a capital expenditure because we are, you know, it is something that's an extraordinary repair, okay? But it's not increasing the value of that asset. It's really not increasing the life of the asset either in this case. It seems like it would.
Oh, so it's still a capital. Okay.
Yeah, it's still a capital expenditure. It's just not increasing the life of, or the cost, you know, the value of that. Because it's just a one-for-one replacement. Okay. So in that case, if we're doing some type of extraordinary repair that is just a necessary repair, so we're taking the existing transmission out and putting in basically the same transmission, it's just, you know, one that works. What you're going to debit and credit is you're going to debit accumulated depreciation on the delivery truck, and then we're going to credit cash because they didn't tell us that we didn't pay cash. We'll assume. Okay. So that one's a little tricky. So we're going to debit the accumulated depreciation on the delivery truck.
So since we're adding a hydraulic lift to that truck, that's enhancing.
Yeah, it'll be different. Yeah. So this one, on the first one, if it's just, you know, replacing something, it's going to affect the delivery truck, but it's affecting your accumulated depreciation account. So it's kind of an indirect effect. Okay. On June 11th, though, we paid $1,350 for installation of a hydraulic lift. Like Megan was saying, that is increasing, right? That's going to increase the value of that asset. So we want to add it to the actual delivery truck asset cost. Okay. So on June 11th, we would debit the delivery truck directly for the $1,350 and credit cash. Okay.
So on the first one, we debited accumulated depreciation because why?
Because it's not actually increasing the value of the delivery truck.
So this thing expense?
It's not an expense. If you think about accumulated depreciation is really, you know, it's a contra asset account. So normally we would credit it, you know, when we're depreciating over time. So
we do the opposite of.
Mm-hmm. So it almost is like an expense. It's kind of, it gets a little tricky, right? But it's not an expense. It's just kind of just taking that, you know, out of the depreciation. So in essence, you're almost adding it to the value of the truck, if that, you know, indirectly, right? Because if you have the truck sitting out here at whatever value it is, I don't know, did they tell us what the value was? I don't think so. We'll just say it was like 40,000. And then you have this accumulated depreciation that's a contra asset. We know as we depreciate every year, we credit it, right? So say the first year depreciation was like 4,000. Well, with this entry, we're debiting it, the 1,890. So we would have to like kind of rebalance that, right? So it'd be 4,000. That would be our accumulated depreciation.
And then you redo your math and you take a lesser hit.
Right. So then your book value, which is what's important there, would be your cost minus that accumulated depreciation. So technically your book value, the value of that truck is actually increasing from that repair. It's just doing it indirectly. Okay. Which to me is a little bit of an advanced topic, but that's how this book handles it. So we'll call it good. Because really, if you had put that 2110 over here, your book value would be the same, right? That's kind of the end game. The book value is going to be the same whether you debit depreciation or debit the truck. but they just like to take it out of depreciation as an indirect increase. Which the takeaway from this is that you're probably going to have to adjust your depreciation or you may have a higher salvage value because you replace that transmission. You think of it that way, right? If you make that type of repair, it may not change your depreciation, but you've increased the value of that truck when you go to sell it because it has a newer transmission. Okay? It's kind of the same as making like home repairs. You know, you redo a kitchen, you know, it may not change the fact that you're moving out, but you might see more return for that. And then the last one, on November 30th, we paid $55 to change the oil and air filter. That's just an ordinary expense, like a normal maintenance item. So, excuse me, we're just going to debit that to repairs and maintenance expense and credit cash. So repairs and maintenance expense gets debited and cash gets credited. So again, it's not like a huge concept in the chapter, but it is important to understand the difference between capital and revenue expenditures. Because it may result in having to readjust your depreciation schedule on that asset. You know, if you have if on like June 11th, that delivery truck has a higher value, so we may need to adjust our depreciation schedule. Or we may just need to adjust our residual value. But, you know, some kind of adjustment might need to be made after a capital expenditure. Any questions on that one? Okay. We'll see what we can get through here on the next couple. The next couple we haven't really talked about yet, so we'll talk about as we kind of go through it. So what can happen with assets is we can actually keep it for how long we thought we were going to keep it. You know, if we said we were going to keep it for 5 years, maybe we did keep it for 5 years and then we sold it. So at that point, we need to figure out, well, did we make money on the sale? Did we lose money? Did we break even? We also, anytime we're disposing of an asset, at any time, whether it's still being depreciated or it's at the end of its life, we have to do some updates to the accounts, okay? So on this one, we're looking at the sale of the fixed asset. So what happens is we have equipment that we acquired on January 8th at the cost of $168,000. It has an estimated useful life of 18 years, residual value of $15,000, and is depreciated by the straight line method. Okay, so it's telling us all of that. It wants us to calculate the book value at the end of the 4th year. Okay, so this one we actually have kind of a review of some of the depreciation stuff. So the first thing we need to do is calculate yearly depreciation, right? So what is my formula, or what would be my formula for this to calculate straight line depreciation? Cost minus residual value.
Over useful life.
Very good. Yeah, divided by the useful life in years. So we would have what? 168,000 minus residual value of 15.
So this is for the first one? Right?
Yeah, we have to calculate the straight line first.
Oh, to get the book value.
Yeah. And then it's 18 years. Okay. So what is my yearly depreciation?
8,500.
8,500?
Yep.
Okay, so all three of these methods are just how we find the depreciation, and then we can use any of those numbers to find book value.
Book value is always cost minus accumulated depreciation.
So yeah, but all those are like straight line, what is it, the units of activity?
And
All
double
those numbers
declining
can be used to find
the book value. Yes, yeah. Those are all depreciation amount, calculating the yearly depreciation.
Different ways.
Yeah, just different ways to get that number.
What's the most common way to do that? Like
Straight line. Straight line is the most commonly used because it's easy. But again, people will use accelerated methods for tax purposes, like to write it off sooner.
The third one.
Mhm.
Okay.
But yeah, straight line is still the most popular. Okay, so that's our yearly depreciation. So every year we're depreciating at 8,500. So what's our total depreciation? Let's do calculation of depreciation first. What's 4 years of depreciation?
34,000.
Yeah, 34,000.
Very good, 34,000. Okay, so at the end of year 4, I've depreciated this asset 34,000. So book value is always cost minus accumulated depreciation, right? So 168,000 minus the 34,000 depreciation, 134,000. Very good. Okay. So my book value at the end of year 4 is 134,000. Okay. That's important when we're dealing with fixed assets. We need to know how much we still have. So why is that important? Well, we have it on the books as valued at 134,000. So what that means is that would be our goal sales price, or we might want more than that, right? If we sold it at this point, we would want to get at least 134,000 for it. You know, anything above that would be a gain. Anything we got below that would be a loss. Okay? So, part B, we need to account for selling it. So we sold this equipment on April 1st of the 5th year for $125,000. Okay. So the first thing I need to do, we can kind of see this is going to be a loss though, right? We sold it for less than the book value. So we sold it for $125,000. We have its current book value at $134,000. Well, that book value was as of December 31st, bless you, of year 4. So that would also be your book value January 1st of year 5, right? Well, what we have to do when we're disposing of assets is if we're disposing of it mid-year, we need to figure out how much it's depreciated to that point. Okay? So if we sold it April 1st, we had it January, February, March. We had it for 3 months. So we need to go ahead and depreciate that asset for the 3 months we've had it in year 5 to get a new book value, okay? Because book value is what we go off of if we made a gain or a loss on the sale. So my first step when I sell equipment is I look at the date. If we had sold it like January 9th or January 5th or something like that, we wouldn't have to do this. But since we sold it April 1st, we've had it for 3 months. So we are going to update our depreciation for those 3 months. So we know our yearly depreciation is $8,500. So then we would multiply that by what? 3 divided by 12 to get 3 months worth of depreciation. So how much did this equipment depreciate in 3 months?
2,125.
Very good, 2,125, 3 months worth.
Will this always be in a yearly and monthly situation, or are we going to have to break it down more into daily?
You will never have to do daily.
Okay.
Thank you, Jesus, right? Or send gauge or.
Before the 15th is the beginning. And then after 15th is the basic count that month for the.
The next
That'd
month,
be
yeah.
4 months. If it was
Yes,
16th.
yeah. If we had sold it on April 16th, we would count April as a month of ownership. So then we
So
would
what
do
is
4 months.
Is 15 after, or is that kind of like?
I would, hopefully they'll never give you the 15th of the month because that's always like, is it
Yeah.
not? I would say 1st through the 15th we would not count it, and anything from the 16th beyond we would.
Okay.
Yeah. But, you know, it gets tricky, right? Because months have different days, but that's what I would do 1st through 15th, 16th, and beyond. Usually they don't give you a 15th just because that is, like, do we count it? Do we not count it? And I think the correct answer would be you could do either way and be right, you know. So we're going to record that depreciation, that 3 months of depreciation. So that's just a standard depreciation expense, the 2125. accumulated depreciation, 2125. So then it's important to know our total depreciation to date and our new book value. Okay, we need.
What's the difference between those?
Depreciation expense.
Remember, depreciation expense is actually the expense account, so that's reducing our income. Accumulated depreciation is that contra asset account, so it's declining the book value of the asset. So one's an asset, one's an expense. Okay. So now we've depreciated this equipment $34,000 plus the $2,125. Okay. So our accumulated depreciation account has been $34,000 and now the $21,125. So its balance is $36,125. Okay. Well, if I thought about it, my new book value, I need to subtract out that additional depreciation. What is that? Like 131,875? Okay, so I have a new book value and a new accumulated depreciation. Okay, so the last part is actually getting rid of the asset. We sold the asset. So in this case, again, we sold it for $125,000. So they gave us $125,000 in cash. We gave them the equipment. Okay. We have our book value as $131,875. Did we make money on the sale of this asset? If we sold it for $125,000? No. We lost money. We have a loss on this because we could take $131,875 minus $125,000. So $6,875 we lost. Not the best sale, but maybe there was something wrong with the equipment. We want to get rid of it. We won't tell them. Just pass it on right now. So when we sell equipment or any asset, I'm always going to debit cash for the amount they gave me. Because, right, my cash increased to $125,000. They gave me $125,000. Now, I no longer own this equipment. So what I need to do is I need to close out the equipment account and the accumulated depreciation on the equipment. So I originally purchased this equipment at $168,000. They gave me that. And it's still on my books at a cost of $168,000. Accumulated depreciation has a credit balance of $36,125. These two accounts get zeroed out because I'm getting rid of that equipment. Well, to zero out an account, you just do the opposite of the balance. So for accumulated depreciation, to zero it out, I'm going to debit it, its balance of $36,125. For the equipment, I would credit equipment. I'm going to do that on the last line because we have another debit. Okay. So on my last line, I want to credit equipment the $168,000. Well, if you added up cash plus accumulated depreciation and subtracted that, the equipment minus cash and accumulated depreciation, you would get your missing piece there, right? Because you want that transaction to balance. But I'll tell you, this is the amount right here, that loss. Any loss on the sale of an asset is like an expense. Think of it like an expense. It's decreasing your profit, right? Well, expenses are increased on the debit side. a loss is always debited. Okay, so that's a compound entry there. So when we have a loss on the sale of an asset, a loss is always debited because it's reducing our profits.
So why are we closing out accumulated depreciation? Why are we doing the opposite?
We are closing those out because we got rid of the equipment. So we sold the equipment, so we want the equipment and its depreciation off of our books. We'll still have that depreciation expense show up on our income statement, but we don't want that equipment on our balance sheet at all anymore because we no longer own it. So whenever we get rid of an asset, whether we sell it or like throw it in the trash or leave it on our curb, whatever we do with it, we zero out its original cost and the accumulated depreciation. Okay, because we don't want it showing up anywhere in our records anymore. It will be on past records, but we got rid of it. Okay, so cash is always debited for whatever cash you receive, and then you close out your accumulated depreciation and your equipment, and then you just have to figure out, did we have a gain or a loss, or did we break even? If we had sold this for $131,875, then we wouldn't have a loss or a gain. Yes, ma'am.
Whether it be a gain or a loss on the line, would that change the debit or credit for all that?
If it were a gain, it would be a credit. That's a good question. So if we had made a gain here, if we had sold it for $135,000, that third entry would be gain on sale of equipment, and it would be a credit. Because basically we're making money off of it, okay? Gains and losses are reported on your income statement. Any questions? I know we have 1 minute. Lots of time, all the time in the world. Okay. We didn't get to the last one, which is really another example like this one. We just have where we see a loss and a gain. So if we need to, we'll go back over that on Tuesday. But have a great weekend. Be working on 8 and 9 homework. So that way Tuesday, when you come in, if you have any questions, we can go over some specific homework. And the plan is to review and test on Thursday. But if we're not feeling ready, we may push that off. Okay?